Hello, 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 and welcome to TLJ Professional Services. In today's video, we will be going over how to choose the right business structure for your business. If you're starting a new business, or maybe you've been running one for a while as a side hustle, you've probably asked yourself one of the most important questions an entrepreneur can face. How should I legally structure my business? It sounds complicated, right? You hear terms like LLC, S Corp, sole proprietorship, and it can feel like you need a law degree just to get started. But here's the good news, it doesn't have to be that complicated. And making the right choice from the beginning can save you thousands of dollars, protect your personal assets, and set you up for future growth. In today's video, we're going to demystify it all. We're going to walk through a complete guide on choosing the right business structure. By the end of this, you'll have a clear understanding of your options and be in a much better position to decide what's best for your business. So grab a coffee, a notepad, and let's build your business on the right foundation. All right, let's get started. Today's presentation is titled Choosing the Right Business Structure for Your Business, a comprehensive guide to understanding business entities, their differences, and how to select the right one. This is going to be comprehensive, but I promise to make it practical and actionable. Think of this as your complete roadmap to one of the most important business decisions you'll ever make. Let's start with the big picture. Why does your business structure matter so much? When you select a business structure, you're not just filling out paperwork, you're making a decision that will fundamentally influence every aspect of how your business operates. Let me break down the four major areas this affects. First, taxes. Your business structure determines how you file taxes, what forms you use, and most importantly, how much you'll pay. Some structures let you avoid double taxation, while others don't. Some allow you to take advantage of special deductions that can save you thousands of dollars every year. We'll get into the specifics, but just know that the difference between choosing the right and wrong structure could cost you tens of thousands of dollars over the life of your business. Second, personal liability. This is huge and is something many new business owners don't think about until it's too late. Some business structures create a legal separation between you personally and your business. That means if your business gets sued or can't pay its debts, your personal assets, your house, your car, your savings account are protected. Other structures offer zero protection. If something goes wrong, creditors can come after everything you own personally. Imagine losing your home because your business got sued. That's the reality for sole proprietors. Third, capital raising. How easy is it going to be to get funding? Can you bring on investors? Can you sell stock? If you want to grow quickly or eventually take your company public, your business structure matters enormously. Some structures make it easy to attract venture capital. Others make it nearly impossible to get even a small business loan. Fourth, administrative complexity. Some business structures require almost no paperwork. Others demand extensive record keeping, regular meetings, detailed minutes, annual reports, and ongoing compliance requirements. You need to honestly assess how much time and money you're willing to spend on administration versus actually running your business. Now, here's something really important. While you can convert from one business structure to another later, it's not simple. Conversions often trigger tax consequences. They can create risks of unintended dissolution. They're complicated and expensive. So while you're not locked in forever, choosing wisely from the start saves you a lot of headaches and money down the road. One more critical point. State regulations vary significantly. What's true in California might be different in Texas or New York. And these regulations evolve with new legislation. That's why, and I'll say this multiple times today, professional consultation with an attorney and accountant is essential. This presentation gives you the knowledge to have informed conversations with professionals, but it doesn't replace personalized legal and tax advice. The bottom line, your business structure shapes everything from your daily operations to your long-term growth potential. Choose wisely and you set yourself up for success. Choose poorly and you could face unnecessary taxes, personal liability exposure, and barriers to growth. Let's start with the simplest business structure, the sole proprietorship. Here's what makes sole proprietorships unique. You don't actually have to do anything to create one. The moment you start doing business as an individual without registering as any other entity type, congratulations. You're automatically a sole proprietor. No paperwork, no filing fees, no complexity. It's just you and your business, which legally are the same thing. This simplicity extends to taxes. As a sole proprietor, you simply add Schedule C to your personal Form 1040 tax return. You report your business income and expenses, and that's it. No separate business tax return, no corporate tax rates. Everything flows through to your personal taxes. This is called pass-through taxation, and it's one of the few advantages of this structure. You also have complete control. There are no partners to consult, no board of directors to answer to, no shareholders to keep happy. Every decision is yours alone. For someone who values autonomy and wants to test a business idea quickly, this can be appealing. But, and this is a massive but, there's a huge downside that you absolutely must understand: unlimited personal liability. Let me explain what this means in practical terms. As a sole proprietor, there is zero legal separation between you and your business. In the eyes of the law, you and your business are the same entity. So if your business gets sued, you get sued personally. If your business can't pay its debts, your personal assets are on the line. Let's say you run a small consulting business as a sole proprietor. A client sues you for $200,000, claiming your advice caused them financial harm. You lose the case. Guess what? They can come after your house, your car, your personal savings, your retirement accounts, everything you own personally. There's no protection whatsoever. Or imagine you take out a business loan to buy equipment. The business struggles and can't make the payments. The bank can seize your personal assets to satisfy that debt. Your personal credit is on the line. Your family's financial security is at risk. This unlimited liability extends to everything. If someone slips and falls at your business location, they can sue you personally. If you accidentally infringe on someone's trademark, they can come after your personal assets. There's simply no shield protecting you. There are other practical disadvantages too. Banks are reluctant to lend to sole proprietorships because they're seen as risky. You can't sell stock to raise capital because there's no separate business entity. And if you want to bring on a partner, you'll need to convert to a different structure anyway. So, when does a sole proprietorship make sense? Honestly, only in very limited situations. If you're running a very low risk business, maybe you're a freelance writer or a consultant with minimal liability exposure, and you're just testing an idea before committing to something more formal, a sole proprietorship might work temporarily. But even then, the moment you have anything worth protecting personally, you should seriously consider forming an LLC. The key takeaway here: sole proprietorships are simple and cheap, but they expose everything you own personally to business risks. For most business owners, that's simply too dangerous. The small amount you save on formation costs isn't worth the massive risk you're taking with your personal assets. Now let's talk about partnerships. If you're going into business with one or more other people, partnerships are one option to consider. But here's what many people don't realize. There are actually two very different types of partnerships, and understanding the difference is crucial. Let's start with limited partnerships, or LPs. In a limited partnership, you have two categories of partners. First, there's at least one general partner who runs the business and makes all the decisions. This general partner has unlimited personal liability, just like a sole proprietor. Everything they own personally is at risk if the business faces lawsuits or debts. Then you have limited partners. These are essentially passive investors. They contribute capital to the business but don't participate in day-to-day management. The big advantage for limited partners is that their liability is limited to the amount they invested. If they put in $50,000, that's the most they can lose. Their personal assets beyond that investment are protected. This structure makes sense for certain situations. Let's say you want to start a real estate development project. You might be the general partner who manages everything, and you bring in limited partners who provide funding but don't want to be involved in operations. Or maybe you're launching a business with a defined time frame. The limited partners get their return when the project completes and then the partnership dissolves. The key thing to understand about LPs, they're designed for situations where you have one or more people actively running the business and others who are purely investors. The active managers take on personal risk in exchange for control, while the passive investors get liability protection in exchange for giving up control. Now let's talk about limited liability partnerships, or LLPs. This is a very different animal. In an LLP, every partner receives limited liability protection. Nobody has unlimited personal liability. Each partner is protected from personal responsibility for other partners' professional errors, negligence, or misconduct. Let me give you a concrete example. Imagine three attorneys decide to practice together. They form an LLP. Attorney A makes a serious error that leads to a malpractice lawsuit. The client wins a $500,000 judgment. In an LLP, attorneys B and C are protected from personal liability for attorney A's mistake. Their personal assets can't be touched to satisfy that judgment. Attorney A is still personally liable for their own actions, but their partners are shielded. This is why LLPs are incredibly popular among licensed professionals, attorneys, accountants, architects, doctors, and consultants. These professions face significant malpractice risks, and professionals want to practice together without being personally liable for their partner's mistakes. However, there's an important limitation. Many states restrict LLP formation to specific licensed professions. You can't just form an LLP for any type of business. State regulations vary significantly, so you need to check what's allowed in your jurisdiction. Both LPs and LLPs benefit from pass-through taxation. The partnership itself doesn't pay taxes. Instead, profits and losses flow through to the partner's individual tax returns. However, general partners in LPs and all partners in LLPs typically must pay self-employment taxes on their share of the profits. There's one more consideration. Partnerships require solid partnership agreements. These legal documents spell out how profits are divided, how decisions are made, what happens if a partner wants to leave, and how disputes are resolved. Without a well-drafted partnership agreement, partnerships can become nightmares when conflicts arise. So, when should you consider a partnership? If you're going into business with others and you're in a profession where LLPs are allowed, an LLP might make sense. If you need to raise capital from passive investors and you're willing to accept unlimited personal liability as the general partner, an LP could work. But for many multi-owner businesses, an LLC often provides better protection and flexibility, which brings us to our next structure. Now we're getting to what has become the most popular business structure for small and medium-sized businesses, the limited liability company, or LLC. LLCs are relatively new. They've only existed since the 1970s, but they've exploded in popularity because they offer something really valuable. They combine the best features of corporations and partnerships while avoiding many of the downsides of both. Let me explain what makes LLCs so attractive. First and foremost, personal liability protection. This is the game changer. An LLC creates a legal separation between you personally and your business. The LLC is its own entity. So if the LLC gets sued or can't pay its debts, your personal assets, your home, your car, your savings are generally protected. Creditors can go after the LLC's assets, but they can't touch your personal property to satisfy business debts. Now, I say generally protected because there are exceptions. You're still personally liable for your own negligent acts. If you personally injure someone or commit fraud, you can still be sued personally. And courts can pierce the corporate veil if you're not maintaining proper separation between personal and business finances. But assuming you operate properly, an LLC provides strong protection. Second, pass-through taxation. Unlike C corporations, LLCs don't pay corporate taxes. Instead, profits and losses pass through to the member's personal tax returns. This means you avoid the double taxation that corporations face. The business income is only taxed once at your personal rate. However, and this is important, LLC members typically must pay self-employment taxes on their earnings. This covers Medicare and Social Security contributions. For 2024, that's 15.3% on the first $160,200 of income. This can be a significant cost, and it's one reason some LLC owners eventually elect S corporation tax treatment, which we'll discuss later. Third, tremendous flexibility. LLCs can have unlimited members. Those members can be individuals, corporations, partnerships, or other LLCs. You can structure ownership percentages however you want. They don't have to match capital contributions. You can distribute profits disproportionately if your operating agreement allows it. You also get to choose how the LLC is managed. In a member managed LLC, all owners participate in daily decisions. In a manager managed LLC, you designate specific people to handle operations while other members are passive investors. This flexibility lets you structure the business to fit your specific situation. Fourth, simpler compliance than corporations. LLCs don't require annual shareholder meetings, boards of directors, or extensive corporate formalities. You still need to maintain proper records and file annual reports in most states, but the administrative burden is much lighter than with corporations. Now, LLCs aren't perfect. Let me cover the disadvantages you need to know about. First, self-employment taxes. As I mentioned, LLC members pay self-employment tax on their earnings. This can be 15.3% on top of regular income taxes. For high-earning LLC owners, this becomes expensive. Some owners address this by electing S corporation tax treatment, which allows them to pay themselves a reasonable salary subject to self-employment tax, and take the rest as distributions not subject to self-employment tax. But this adds complexity and requires careful planning with an accountant. Second, limited lifetime in some states. Some states impose lifetime limitations of 30 to 40 years on LLCs. When that period expires, the LLC must be dissolved and reformed. This isn't common, but it's something to be aware of in certain jurisdictions. Third, member changes can trigger dissolution. In some states, when members join or leave, the LLC may be required to dissolve and reform unless your operating agreement specifically addresses this. This is why having a well-drafted operating agreement is crucial. Fourth, professional restrictions. Some states don't allow certain licensed professionals like doctors or lawyers to form standard LLCs. Instead, they must form professional LLCs, PLLCs, which have additional requirements. Fifth, state-specific variations. LLC laws vary significantly from state to state. Formation fees range from under $100 to over $500. Some states impose annual franchise taxes or fees. California, for example, charges an $800 annual minimum franchise tax. You need to research your specific state's requirements. So when does an LLC make sense? For most small to medium-sized businesses with any meaningful liability risk, an LLC is the sweet spot. If you're running an e-commerce business, a consulting firm, a marketing agency, a restaurant, a retail store, or any business where you have personal assets to protect, an LLC typically offers the best balance of protection, tax treatment, and simplicity. The key is to maintain proper separation between personal and business finances, file all required reports, and follow your state's requirements. Do that, and an LLC provides excellent protection while keeping things relatively simple. Now let's talk about corporations. When most people think of big business, They're thinking of corporations. And while corporations offer the strongest legal protections, they also come with significant complexity and cost. There are actually two types we need to discuss: C corporations and S corporations. Let's start with C corporations. A C corporation is a completely separate legal entity from its owners. It's like creating an artificial person that exists independently. This separation provides the strongest possible protection against personal liability. Shareholders, directors, and officers are generally not personally responsible for corporate debts or lawsuits. The corporation owns its assets, enters into contracts, and is responsible for its own obligations. This structure offers several major advantages. First, unlimited capital raising potential. C corporations can sell stock to unlimited numbers of investors, regardless of their nationality or whether they're individuals or entities. This makes C Corp the preferred structure for businesses seeking venture capital or planning to go public. Investors understand corporations, and the structure accommodates complex ownership arrangements, multiple classes of stock, and sophisticated investment terms. Second, perpetual existence. A corporation continues to exist regardless of what happens to its shareholders. Shareholders can sell their stock, die, or leave, and the corporation keeps operating without interruption. This permanence makes corporations attractive for businesses planning long-term growth or eventual sale. Third, tax-deductible employee benefits. Corporations can offer employees benefits like health insurance, retirement plans, and life insurance, and deduct these costs as business expenses. This can be valuable for attracting and retaining talent. Fourth, credibility. Having Inc. after your business name signals permanence and professionalism. Some clients and partners prefer working with incorporated businesses, but C corporations have significant disadvantages that you must understand. The big one, double taxation. Here's how it works. The corporation pays corporate income tax on its profits. The current federal corporate tax rate is 21%, thanks to the 2018 tax reform that reduced it from 35%. But then, when the corporation distributes profits to shareholders as dividends, those shareholders pay personal income tax on those dividends. So the same money gets taxed twice, once at the corporate level and again at the personal level. Let me give you an example. Your corporation earns $100,000 in profit. It pays $21,000 in corporate tax, 21%, leaving $79,000. You distribute that $79,000 as dividends to shareholders. Those shareholders then pay personal income tax on that $79,000, let's say 24% federal plus state taxes. So that original $100,000 in profit ends up being taxed at both the corporate and personal levels. This double taxation significantly reduces the after-tax money that ends up in owners' pockets. Second major disadvantage, complexity and cost. Corporations require extensive record keeping, regular board meetings, detailed minutes, annual reports, and ongoing compliance with securities laws if you have outside investors. You'll need to maintain corporate formalities to preserve that liability protection. This means higher legal and accounting costs, more administrative time, and greater complexity. Third, less flexibility. Corporations have rigid structures. You must have a board of directors, officers, and shareholders. You must follow corporate formalities. You can't just distribute profits however you want. You have to follow proper dividend procedures. So when does a C corporation make sense? Primarily when you're building a high growth business that will seek venture capital or eventually go public. If you're launching a tech startup and plan to raise millions from VCs, you'll almost certainly need to be a C Corp. If you're building a business you hope to sell for tens of millions of dollars, a C Corp might be appropriate. But for most small businesses, the double taxation and complexity outweigh the benefits. Now let's talk about S corporations. An S corporation isn't actually a different business entity. It's a tax election. You form a regular corporation, then file IRS Form 2553 to elect S corporation tax status. This election allows you to avoid double taxation while maintaining corporate liability protection. Here's how it works. S corporations are pass-through entities for tax purposes. The corporation doesn't pay corporate income tax. Instead, profits and losses pass through to shareholders' personal tax returns, just like with LLCs and partnerships. This eliminates the double taxation problem. S Corp also offer a valuable tax advantage. You can reduce self-employment taxes. Here's the strategy. As an S Corp owner, you pay yourself a reasonable salary for the work you do. That salary is subject to employment taxes, Social Security, and Medicare, but then you can take additional profits as distributions, which are not subject to self-employment taxes. This can save you thousands of dollars compared to an LLC, where all profits are subject to self-employment tax. Let me give you an example. Say your business earns $150,000 in profit. As an LLC member, you'd pay self-employment tax 15.3% on the full $150,000. That's about $23,000 in self-employment taxes. As an S Corp owner, you might pay yourself a $80,000 salary subject to employment taxes and take $70,000 as distributions, not subject to employment taxes. This could save you over $10,000 in taxes. Sounds great, right? But S corporations have strict limitations. First, shareholder restrictions. S Corp can have no more than 100 shareholders, and all shareholders must be U.S. citizens or residents. You can't have corporate shareholders or partnerships as owners. This makes S Corp unsuitable for businesses seeking venture capital or planning complex ownership structures. Second, one class of stock. S Corps can only have one class of stock. You can't have different classes with different voting rights or profit distributions. This limits your flexibility in structuring ownership. Third, reasonable compensation requirement. The IRS requires S Corp owners who work in the business to pay themselves a reasonable salary before taking distributions. If you try to game the system by paying yourself $30,000 and taking $200,000 in distributions, the IRS will likely challenge this and reclassify those distributions as salary subject to employment taxes. Fourth, strict filing and operational requirements. S Corp must follow all the corporate formalities, board meetings, minutes, annual reports, etc. You also must file Form 1120S annually and provide Schedule K1s to all shareholders. So when does an S corporation make sense? For profitable small businesses with U.S.-based owners who want to reduce self-employment taxes while maintaining liability protection. Many successful LLCs eventually elect S Corp tax treatment once they're profitable enough that the tax savings outweigh the additional complexity and costs. The bottom line on corporations, C Corp are for high growth businesses seeking significant investment or planning to go public. S Corps are for profitable small businesses wanting to reduce self-employment taxes. For most small businesses just starting out, an LLC is simpler and more appropriate, with the option to elect S Corp tax treatment later if it makes sense. This is where a lot of people get confused. So I want to spend some time making the differences between LLCs and LLPs crystal clear. Both offer liability protection, both have limited liability in their names, but they're actually quite different structures designed for different situations. Let's start with ownership requirements. LLCs can have just one owner, called a single member LLC, or unlimited members. This flexibility is huge. If you're a solo entrepreneur, you can form an LLC by yourself and get liability protection. If you later want to bring on partners, you can add members without changing your structure. LLPs, on the other hand, require at least two partners. You cannot form an LLP as a solo practitioner. This makes sense because LLPs are designed for partnerships, not solo businesses. Now let's talk about liability protection because this is where the differences become really important. In an LLC, members are protected from business debts and claims. If the LLC can't pay its bills or get sued, creditors generally can't go after members' personal assets. The protection is comprehensive. It covers business debts, contractual obligations, and most lawsuits against the business. Of course, you're still personally liable for your own negligent acts, but the LLC shields you from general business liabilities. In an LLP, the protection is more targeted. Partners are specifically protected from personal liability for other partners' professional errors, negligence, or misconduct. Let me emphasize that. Other partners' mistakes. You're still personally liable for your own actions. Here's a concrete example. Three CPAs form an LLP. Partner A commits malpractice by giving terrible tax advice that costs a client $300,000. The client sues and wins. Partner A is personally liable for that judgment. But partners B and C are protected. Their personal assets can't be touched to satisfy that judgment, even though they're partners in the same firm. This targeted protection is exactly what licensed professionals need. They want to practice together and share resources, but they don't want to be personally liable for their partner's professional mistakes. LLPs provide that specific protection. However, and this is important, LLPs may not protect partners from general business debts the same way LLCs do. The protection is primarily focused on professional liability, not necessarily all business obligations. This varies by state, so you need to check your jurisdiction's specific laws. Management structure is another key difference. LLCs offer tremendous flexibility. You can choose member manage, where all members participate in decisions, or manager manage, where designated managers run things while other members are passive. You can structure ownership percentages independently of capital contributions. You can distribute profits disproportionately if your operating agreement allows it. LLPs typically operate with more egalitarian partnership structures. Partners generally share management responsibilities and decision-making authority more equally. While you can create different arrangements in your partnership agreement, the default structure is more collaborative and equal. Professional restrictions are crucial to understand. LLCs are available for almost any type of business. Some states restrict certain licensed professionals from forming standard LLCs, requiring them to form professional LLCs, PLLCs, instead, but generally, LLCs are widely available. LLPs are often restricted to specific licensed professions. Many states only allow attorneys, accountants, architects, doctors, and similar licensed professionals to form LLPs. If you're running a retail store or a tech company, you probably can't form an LLP even if you wanted to. This restriction exists because LLPs were specifically created to address the needs of professional service firms. Taxation is similar for both structures. Both LLCs and LLPs are pass-through entities by default. Profits and losses flow through to owners' personal tax returns. Both can elect corporate tax treatment if desired. Both typically require owners to pay self-employment taxes on their earnings. So when should you choose an LLC versus an LLP? Choose an LLC if you might be a solo owner or you want flexibility in the number of owners. You want comprehensive protection from business debts and liabilities. You want maximum flexibility in management structure and profit distribution. You're not in a licensed profession or your state allows LLCs for your profession. You want a structure that works for a broad range of business types. Choose an LLP if you're in a licensed profession, attorney, accountant, architect, doctor. Your state allows or requires LLPs for your profession. You specifically want protection from other partners' professional malpractice. You're comfortable with a more traditional partnership management structure. You have at least two partners. For most businesses, an LLC is the better choice because of its flexibility and comprehensive protection. But for licensed professionals in states where LLPs are available and appropriate, an LLP can be the perfect fit. One final note. Some states offer professional LLCs, PLLCs, as an alternative for licensed professionals. PLLCs combine LLC flexibility with professional practice requirements. If you're a licensed professional, you should consult with an attorney about whether an LLC, PLLC, or LLP makes the most sense for your specific situation and state. The key takeaway: don't assume LLC and LLP are interchangeable. They're designed for different situations, offer different types of protection, and have different requirements. Choose based on your specific circumstances, profession, and state regulations. All right, now we're going to tackle some dangerous myths that I hear all the time. These misconceptions lead entrepreneurs to make costly mistakes that can haunt them for years. Let's debunk these myths one by one. Myth number one: LLC formation is complicated and difficult. This is probably the most common myth, and it stops a lot of people from forming LLCs when they really should. The truth: forming an LLC is actually pretty straightforward in most states. Here's what you typically need to do: choose a business name, file articles of organization with your state, usually a simple 1-2 page form, pay the filing fee ranging from $50 to $500 depending on your state, and create an operating agreement. That's basically it. You can do this yourself in an afternoon, or you can hire a service to do it for you for a few $100s. Compare this to the complexity of running a corporation with boards of directors, annual meetings, and extensive formalities, and you'll see that LLCs are actually quite simple. Don't let fear of complexity stop you from getting the protection you need. Myth number two: forming your LLC in another state helps you avoid taxes. This is a big one, and it's completely false. I see people all the time forming LLCs in Delaware, Nevada, or Wyoming because they've heard these are tax haven states. Here's the reality: you pay taxes where you actually operate your business, not where you formed your LLC. If you live in California and run your business in California, you're paying California taxes. Period. It doesn't matter if your LLC is formed in Delaware. In fact, forming in another state while operating in your home state means you'll need to register as a foreign LLC in your home state, which means you're paying fees in 2 states instead of one. The only time forming in another state makes sense is if you're actually operating in multiple states, or you have specific legal reasons, like complex ownership structures, that benefit from that state's LLC laws. For 99% of small businesses, form your LLC in the state where you actually operate. Myth number three: home-based businesses or single-owner businesses don't need LLCs. This myth is dangerous because it leaves people completely exposed to personal liability. The truth is that liability protection is crucial regardless of where you operate or how many owners you have. Think about it. If you're running a consulting business from your home office and a client sues you for $200,000, do you want your personal home at risk? If you're a freelance web designer working alone and you accidentally use copyrighted material, do you want your personal savings account vulnerable? The location of your business and the number of owners have nothing to do with whether you need liability protection. What matters is whether you have personal assets worth protecting and whether your business activities create any liability risk. For most businesses, the answer is yes to both. Myth number four: LLCs cannot be publicly traded. This is technically false, though it's complicated. LLCs can be publicly traded, but they're structured as partnerships for tax purposes. This is complex and uncommon, but it's possible. Some large companies, including certain real estate investment trusts, operate as publicly traded partnerships. The reason this myth persists is that it's much more common for companies planning to go public to structure as C corporations, which have well-established frameworks for public trading. But the blanket statement that LLCs can't be publicly traded is simply incorrect. Myth number five: you must be a U.S. citizen to own an LLC. Completely false. Foreign nationals can absolutely own LLCs. Instead of a social security number, foreign owners simply need to obtain a taxpayer identification number, TIN, from the IRS. This myth stops international entrepreneurs from starting U.S. businesses when they're perfectly entitled to do so. If you're a foreign national wanting to operate a business in the United States, an LLC is often an excellent choice. You'll need to navigate some additional tax considerations and possibly obtain an individual taxpayer identification number, ITIN, but there's no citizenship requirement. Myth number 6, LLCs are only for small businesses. This myth couldn't be more wrong. Large companies use LLCs all the time. Want proof? Amazon uses LLCs for many of its subsidiaries. Why? Because LLCs offer liability protection and tax advantages that make sense even for massive companies. LLCs are used for real estate holdings, investment vehicles, joint ventures, and subsidiaries of large corporations. The structure scales from a solo freelancer to multi-billion-dollar operations. Don't let anyone tell you that you'll outgrow an LLC. You might eventually choose to convert to a corporation for specific reasons like going public or attracting certain types of investors, but it won't be because LLCs are only for small businesses. Myth number 7, the corporate veil provides unlimited protection. This is perhaps the most dangerous myth because it creates false confidence. Yes, LLCs and corporations provide liability protection through the corporate veil, the legal separation between the business entity and the owners. But this protection is not absolute. Courts can pierce the corporate veil under certain circumstances. This happens when the LLC is merely an extension of the owner with no real separation. The owner has used the LLC fraudulently. The LLC has been used to unjustly damage creditors. The owner hasn't maintained proper separation between personal and business finances. The LLC is undercapitalized, doesn't have enough assets to reasonably operate. Let me give you examples of what not to do. Don't mix personal and business funds in the same bank account. Don't use business funds to pay personal expenses without proper documentation. Don't fail to maintain required records or file required reports. Don't operate the LLC as if it's just your personal piggy bank. If you do these things, a court can pierce the veil and hold you personally liable despite having an LLC. The protection is only as good as your commitment to maintaining proper corporate formalities and separation. The key takeaway from all these myths: don't let misconceptions stop you from forming the right structure, but also don't assume that forming an LLC is a magic bullet that requires no ongoing attention. Get accurate information, maintain proper practices, and you'll have the protection you need. Now, let's talk about some recent legal changes that affect business structures. The regulatory landscape is always evolving, and there are two major changes from 2024 and 2025 that you need to know about. First, the Corporate Transparency Act, which took effect January 1st, 2024. This is a big deal, and a lot of business owners don't even know about it yet. The CTA was passed to combat money laundering, tax fraud, and terrorism financing by requiring businesses to report information about their beneficial owners to the Financial Crimes Enforcement Network, or FinCEN. Here's what you need to know. If you formed an LLC, corporation, or similar entity after January 1st, 2024, you must file a beneficial ownership information report with FinCEN. This report includes information about your business, your beneficial owners, and your company applicants. What information do you need to report? Names, addresses, dates of birth, and identification numbers like driver's license or passport numbers for anyone who owns 25% or more of the company or exercises substantial control over it. If your business was formed before January 1st, 2024, you still need to file, but you don't have to report information about company applicants, just the business and beneficial owners. Now, here's the important part. This isn't a one-time filing. Whenever there are changes to beneficial ownership or control, you must update your filing within 30 days. This includes when a beneficial owner changes their address, a beneficial owner legally changes their name, a beneficial owner gets a new driver's license or identification document, someone new gains substantial control over the company, ownership percentages change significantly, Failure to comply can result in civil penalties of up to $500 per day and criminal penalties including fines up to $10,000 and up to 2 years in prison. The government is serious about this. There are some exemptions. Certain types of businesses don't have to file, including publicly traded companies, banks, insurance companies, and some others. But most small LLCs and corporations must comply. My advice: if you formed a business entity in 2024 or later, make sure you filed your BOI report. If you formed earlier, check whether you're required to file and set up a system to remember to update your filing whenever ownership or control changes. This is not something you want to ignore. Second, the One Big Beautiful Bill Act, signed July 4th, 2025. This comprehensive tax legislation made several changes that affect business structures. First, it made permanent the federal tax brackets that were set to expire. The 7 brackets, 10%, 12%, 22%, 24%, 32%, 35%, and 37%, are now permanent. This provides certainty for tax planning. Second, it modified the Section 199A qualified business income deduction. This is the 20% deduction that owners of pass-through entities like LLCs, S Corp, and partnerships can take on their business income. The new law potentially allows more service business owners to claim this deduction by adjusting the income thresholds and modifying some of the restrictions. If you own a pass-through entity, this could save you significant money. For example, if your LLC earns $100,000 in qualified business income and you can take the full 20% deduction, that's $20,000 that isn't subject to income tax. The exact rules are complex and depend on your income level and type of business, so work with a tax professional to maximize this benefit. Third, the law increased the gross assets threshold for certain tax provisions to $75 million indexed for inflation. This affects various tax rules and reporting requirements. Fourth, it added an additional $6,000 deduction for individuals aged 65 and older for tax years 2025 through 2028. If you're a business owner in that age range, this is extra money in your pocket. The key point here is that tax laws affecting business structures continue to evolve. What was true 5 years ago might not be true today. This is why working with a qualified accountant who stays current on tax law changes is so important. These recent changes also illustrate why choosing a flexible business structure matters. LLCs, for example, can elect different tax treatments as laws change. If new legislation makes S corporation treatment more advantageous, an LLC can elect that treatment without changing its legal structure. This flexibility is valuable in a changing regulatory environment. The bottom line: stay informed about legal and tax changes affecting your business structure. Join business owner groups, subscribe to updates from the SBA or your state's business agency, and maintain a relationship with a good accountant and attorney who can alert you to changes that affect your business. Now let's talk about what happens if you need to change your business structure. Maybe you started as a sole proprietor and now you want LLC protection. Maybe your LLC is growing and you need to convert to a corporation to attract investors. Whatever the reason, it's important to understand that conversions are possible, but they require careful planning. There are 3 primary methods for converting between business structures, and each has different implications. Method number 1, statutory conversion. This is the simplest and most efficient method when it's available. Statutory conversion allows you to directly convert from one entity type to another through a simple filing procedure with your state. For example, many states allow you to convert an LLC to a corporation by filing a certificate of conversion along with articles of incorporation. The LLC essentially transforms into a corporation. The business continues operating with the same assets, contracts, and liabilities, just under a new structure. The advantages of statutory conversion are significant. It's relatively straightforward, typically involves just one filing and maintains continuity of contracts and obligations. You don't have to renegotiate contracts or transfer assets separately. The disadvantage? Not all states allow statutory conversion for all entity types. You need to check whether your state permits the specific conversion you want to make. Method number 2, inter-entity merger. If statutory conversion isn't available, the inter-entity merger method might work. Here's how it works. You create a new entity of the desired type, then merge your existing entity into the new one. The original entity ceases to exist, and the new entity continues with all the assets, liabilities, and contracts. For example, let's say you want to convert your LLC to a C corporation. You would form a new corporation, then file a merger agreement with your state, merging the LLC into the corporation. The LLC disappears, and the corporation continues operating with everything the LLC had. This method maintains continuity better than dissolution and formation, which we'll discuss next. But it's more complex than statutory conversion. You need to draft merger documents, get approval from all owners, and file the appropriate forms with your state. Method number 3, dissolution and formation. This is the most complex method, but it's available in all jurisdictions. You dissolve the existing entity, form a new entity of the desired type, and transfer all assets from the old entity to the new one. For example, to convert a sole proprietorship to an LLC, you would form a new LLC and contribute your business assets into it. Since a sole proprietorship isn't a separate legal entity, there's nothing to formally dissolve. You just start operating as the LLC. The challenge with this method is that you need to transfer everything individually. Contracts may need to be renegotiated or assigned. Assets need to be formally transferred. Licenses and permits may need to be reissued in the new entity's name. This creates opportunities for things to fall through the cracks. Special case, LLC to S corporation tax election. Here's something really important that many business owners don't realize. If you have an LLC and you want the tax benefits of an S corporation, you don't necessarily need to convert your entity structure at all. An LLC can elect to be taxed as an S corporation by filing IRS Form 2553. You remain an LLC legally. You keep your operating agreement, your state registration stays the same, everything continues as before. But for tax purposes, you're treated as an S corporation. This means you can pay yourself a reasonable salary subject to employment taxes and take additional profits as distributions, not subject to self-employment taxes. This election gives you the tax benefits of an S Corp without the complexity of actually converting your legal structure. It's a great option for profitable LLCs where the self-employment tax savings justify the additional complexity of S Corp tax compliance. Key considerations for any conversion. Regardless of which method you use, there are several critical considerations. First, tax consequences. Conversions can trigger taxable events. For example, converting from a C corporation to an LLC might trigger recognition of built-in gains. Converting from a partnership to a corporation might trigger taxes on appreciated assets. You absolutely must consult with a tax professional before converting to understand the tax implications. Second, existing contracts. Some contracts include provisions that trigger renegotiation or termination if the business structure changes. Review all major contracts before converting. Third, timing. The timing of your conversion affects tax implications. Converting at the end of a tax year versus the beginning can have different consequences. Plan carefully. Fourth, state-specific rules. Every state has different rules governing conversions. What's allowed in Delaware might not be allowed in California. Research your state-specific requirements. Fifth, professional guidance. I cannot stress this enough. Do not attempt a conversion without professional help. Hire an attorney to handle the legal aspects and an accountant to handle the tax aspects. The cost of professional help is far less than the cost of doing it wrong. When should you consider converting? You might consider converting when your liability risk has increased and you need better protection. You're seeking outside investment that requires a different structure. Your tax situation has changed, and a different structure offers significant savings. You're planning to go public or be acquired. Your state's regulations have changed. Your business has grown beyond what your current structure can accommodate. But remember, conversion involves cost, complexity, and potential tax consequences. Don't convert just because someone told you to or because you read an article suggesting a different structure might be better. Convert only when there's a clear, compelling reason that justifies the cost and complications. The key takeaway: conversions are possible, but they're not simple. Plan carefully, get professional help, and make sure the benefits clearly outweigh the cost before proceeding. All right, we've covered all the different business structures, debunked myths, and discussed legal changes. Now let's bring it all together with a strategic framework for actually making your decision. Choosing the right business structure isn't about picking the best option. There's no single best structure for everyone. It's about finding the optimal structure for your specific situation. To do that, you need to systematically evaluate four fundamental questions. Question number one: what level of liability protection do I need? This is the most important question for most business owners. To answer it, consider: what's your industry's risk level? If you're a consultant giving advice, a contractor working on people's homes, a healthcare provider, or a manufacturer selling products, you face significant liability risk. If you're a low-risk freelance writer or graphic designer, your risk is lower. What's the potential for lawsuits? Be realistic. In our litigious society, almost any business can face lawsuits, but some businesses are more likely targets than others. What personal assets do you have at stake? If you own a home, have significant savings, or have other valuable personal assets, you need strong protection. If you're young with few assets, you might accept more risk, though I'd still recommend protection. Here's a general guide: high risk plus significant personal assets equals you need strong protection. Consider an LLC or corporation. Moderate risk plus some personal assets equals LLC is probably your best bet. Low risk plus minimal personal assets equals you might start as a sole proprietor, but consider forming an LLC as you build assets. Question number two: how do I want to pay taxes? Tax treatment varies significantly across structures. Consider: do you want pass-through taxation, where business income flows to your personal return, or corporate taxation, where the business pays taxes separately? For most small businesses, pass-through is preferable because it avoids double taxation. Are you eligible for the qualified business income deduction? If you operate a pass-through entity, LLC, S Corp, partnership, you might be able to deduct 20% of your qualified business income. This can save thousands of dollars. However, there are income limits and restrictions for certain service businesses. How much are you earning? If your business is highly profitable, the self-employment tax burden on LLC income can be significant. You might benefit from electing S corporation tax treatment to reduce self-employment taxes. Do you want flexibility to change tax treatment later? LLCs offer tremendous flexibility. You can be taxed as a sole proprietorship, partnership, S Corp, or C Corp. This flexibility is valuable as your situation changes. Question number three: what are my capital requirements? How you plan to fund your business matters enormously. Are you bootstrapping with personal savings? If so, structure is less critical from a funding perspective. Do you need bank loans? Banks are more willing to lend to LLCs and corporations than to sole proprietorships. Are you seeking angel investors or venture capital? If so, you'll almost certainly need a C corporation. VCs strongly prefer C corps because of the flexibility in creating different classes of stock, the ability to have unlimited investors, and the clear path to going public or being acquired. Do you plan to bring on partners or investors later? If so, choose a structure that accommodates multiple owners. LLCs and corporations work well. Sole proprietorships don't. Are you planning to go public eventually? If so, you need a C corporation. While you can convert later, many companies start as C Corp if this is the long-term plan. Question number 4, how much administrative complexity can I manage? Be honest with yourself about how much time and money you're willing to spend on administration versus actually running your business. Sole proprietorships require minimal paperwork. Just file Schedule C with your personal tax return. LLCs require moderate administration. You need to file annual reports in most states, maintain proper records, and keep business and personal finances separate. But there are no board meetings or extensive corporate formalities. Corporations require extensive administration. You need a board of directors, regular board meetings, detailed minutes, annual reports, and strict compliance with corporate formalities. You'll spend more on legal and accounting fees. If you're a solo entrepreneur who wants to focus on your craft, an LLC offers good protection without overwhelming complexity. If you're building a high growth company with a team, you can handle more complexity. Beyond these 4 questions, also consider industry requirements. Some professions have specific requirements. Lawyers might need an LLP or PLLC. Doctors might need a professional corporation. Research your industry's norms and regulations. Future vision. Where do you see your business in 5 to 10 years? Are you building something you'll eventually sell? Planning to pass it to your children? Want to take it public? Your long-term vision should influence your structure choice. Number of owners, solo, choose a sole proprietorship or single member LLC. Multiple owners, consider a partnership, multi-member LLC or corporation. State specific factors, research your state's fees, taxes, and regulations for different structures. Some states are more expensive or restrictive than others. The key is to match the structure to your specific situation, not to follow generic advice or do what your friend did. Your business is unique and your structure choice should reflect that. We've covered a lot of ground today, so let's bring everything together with a clear action plan for making your decision with confidence. Step 1, complete a comprehensive assessment. Take time to really think through your situation. Don't rush this decision. Consider, what type of business are you running? What are your industry specific requirements and risks? How many owners will there be? What personal assets do you need to protect? What are your immediate funding needs? Where do you see the business in 5 to 10 years? What's your exit strategy? Write down your answers. Be specific. This assessment forms the foundation for your decision. Step 2, rank your priorities. You can't optimize for everything, so you need to prioritize. Rank these factors in order of importance to you: liability protection, tax efficiency, operational simplicity, fundraising capability, future flexibility, cost of formation, and maintenance. Your priority ranking will guide your choice. If liability protection is your top priority and you're willing to accept more complexity, a corporation might make sense. If simplicity is paramount and you have minimal liability risk, a sole proprietorship might work temporarily. Most people find that LLCs offer the best balance across these factors. Step 3, research state-specific requirements. Don't make assumptions based on general information. Research your state's specific filing fees for different structures, annual fees or franchise taxes, ongoing compliance requirements, professional restrictions for your industry, processing times for formation documents. Your state Secretary of State website usually has this information. Some states are much more expensive or restrictive than others, and this affects your decision. Step 4, consult with professionals. This is absolutely critical, and I cannot emphasize it enough. Before you finalize your decision, consult with a business attorney who can explain the legal implications of each structure, help you understand liability protection, review your specific situation, and ensure you're complying with all requirements. An accountant or tax professional who can analyze the tax consequences of each structure, help you understand how much you'll actually pay in taxes, explain deductions and benefits available to each structure, and project your tax liability under different scenarios. A business counselor, perhaps from SCORE or your local small business development center, who can provide strategic advice about which structure aligns with your business goals. Yes, professional consultation costs money, but the cost of choosing the wrong structure, whether that's unnecessary taxes, inadequate liability protection, or barriers to growth, is far higher. Think of professional fees as insurance against costly mistakes. Step 5, choose your structure based on your assessment, priorities, research, and professional advice. Make your decision. Choose the structure that best balances your current needs with future flexibility. Remember, you're not locked in forever. If your needs change dramatically, you can convert to a different structure. But conversions involve costs and complexity, so choosing wisely now saves headaches later. Step 6, understand your conversion options. Even as you choose your initial structure, understand that conversion is possible if needed. You might start as an LLC and later elect S corporation tax treatment. You might start as a sole proprietor and convert to an LLC as your business grows. You might start as an LLC and convert to a C corporation when you're ready to seek venture capital. Knowing that conversion is possible, though not simple, should give you confidence to start with the structure that makes sense now rather than trying to predict every possible future scenario. Here's my bottom line after everything we've discussed today. For most small businesses, and I'm talking about the vast majority of small businesses, an LLC offers the optimal balance of liability protection, tax treatment, simplicity, and flexibility. Unless you have a specific reason to choose something else, an LLC is probably your best bet. But remember, the right structure depends entirely on your unique circumstances. Don't just follow generic advice. Don't just do what your friend did. Don't choose based on what sounds cool or impressive. Do your homework, assess your situation honestly, consult with professionals, then make an informed decision that aligns with your specific needs, goals, and risk tolerance. Choosing your business structure is important, but don't let it paralyze you. I've seen entrepreneurs spend months agonizing over this decision when they should be out there building their business. Yes, choose carefully. Yes, get professional advice. But don't let perfect be the enemy of good. For most small businesses, forming an LLC is a safe, solid choice that provides good protection without excessive complexity. If you're unsure, that's probably where you should start. You can always adjust later if needed. The most important thing is to make a decision and move forward. Your business structure matters, but is not as important as actually building a great business, serving customers well, and creating value in the world. As the owner of TLJ Professional Services, Inc., I have over 40 years of experience helping individuals, small businesses, and nonprofits build strong financial foundations, whether that's through business structure, bookkeeping, tax planning, or long-term growth strategies. Before we wrap up, please note that this presentation is intended for educational purposes only and should not be considered legal or tax advice. Every business situation is unique, so I always recommend consulting with qualified professionals about your specific circumstances. If you're ready to take the next step in setting up your business the right way, I'd love to help you get started. I'm offering a free 30-minute consultation where we'll walk through your goals and determine the best structure for your business moving forward. You can schedule your call using the link below in the description. I've also included a link to download the Business Structure Workbook, which walks you through everything we discussed today. It's a great tool to help guide your decision-making process before our call. I look forward to connecting with you and helping you build a business that's positioned for success. Thank you for watching this presentation. I hope it's given you the knowledge and confidence you need to choose the right business structure for your business. If you found this helpful, please like, subscribe, and share with other entrepreneurs who might benefit. Now go out there and build something amazing. Many blessings.